what I always tell people is that if you can't find three ways in which you can lose all your money using numbers, you probably shouldn't invest.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Aleksey. I am butchering your name, so you're going to correct me, but it's Chernobelskiy. How
Pretty good.
close did I get?
I'll give it an 8 out of 10.
So Aleksey advises limited partners, LPs, on existing and future investments. He writes weekly to 4,000 investors at lplessons.co to explain how to properly vet and think about LP investments, just in the grand scheme of your entire portfolio. And he also consults and helps general partners on matters relating to LP, like capital calls, feedback on investment decks, and so on. And also as a big connect with them on LinkedIn. There's a lot of value on LinkedIn too. So connect with them on LinkedIn and on lplessons.co. Prior to advising LPs, Aleksey ran Store Capital's $10 billion commercial real estate portfolio and oversaw the firm's underwriting team. So a lot of experience prior to this. And look, man, you are providing, in my opinion, a great service to people. And I have been trying to get the word out there similar to you, but you've been much more effective. And I think it is better. I mean, I'm not going to stop putting content out there similar to yours, but yours is coming from somebody who's not a GP running their own deals, so it's non-biased information. I try not to be biased, but ultimately I still am. It's my own company. I try really hard not to be biased. But you're putting great content out there, and you are ruffling feathers, right? There are GPs. We talked before we hit the record button. There are GPs out there that are upset at what you're doing because you're exposing the bad actors, and not necessarily to be negative about the industry, but really to just educate, to make sure people that are investing are thinking about the right thing. So welcome to the show. Really appreciate you joining us. Anything that I missed about your background that you want to add on to the listeners, maybe a little bit more detail, and then we'll dive in.
Yeah, thanks for having me. I don't think you missed anything. Again, I appreciate you having me on. The only thing I would slightly correct would be I actually don't call people out. Like, I'm very careful about that because
Yeah.
meaning I have
Yeah.
never publicly ever called out a GP, no matter how bad something was.
You're
Um,
calling out, not necessarily calling out GPs, you're exposing the truth of saying,
right,
look,
but I
there are,
always do it in an anonymous way. In other
yes,
words, you
100%.
can never tell who the GP is, and I do that on
Yeah.
purpose.
Yeah.
The context here is I think great investors sometimes will make mistakes.
Yeah.
And investments inherently are risky too. So like
Yeah.
there are many cases of great investment managers and great GPs, by the way, that at some point lost money over a long period of time. I think it happens, right? Because
Yeah.
there's cycles. Um,
I
and
was talking with a investor, a GP that's been in the business for like 45 years. And
yeah,
what the thing he said is that if you're in this business long enough, you will lose other people's money.
yeah, yeah. I'll tell you, recently I reviewed a deck for a GP who's been in business for I don't know exactly, but like somewhere between 20 to 30 years. Um, and I'll just say that it's like a large firm. So like, I think when you get large, there's sort of you become a little bit more of a market maker. or a price setter in a sense in terms of like fees and stuff like that, right?
Sure.
I give an example from like Renaissance in the top 15 syndication mistakes article. But we asked them for the track record and they sent it to us in like seconds. And it was like literally every single deal from like 1990 or something like that. Um, and it kind of was like it was just a breath of fresh air because as you said, there's some deals where they lost like 15% of capital. I think the worst one was maybe 30% loss. Now, I think it always matters when that was and what happened too, right? For example, if you made if you only got your capital out and didn't lose any money, so is that a win or like is that a terrible investment? I think the answer is it really depends, right? Like if I told you that a massive fire broke out and all these issues happened, right? That were like legitimate issues that couldn't have been foreseen. Oh, and by the way, you bought it in 2007 and you had to sell it in 2010 for whatever reason. Um, versus you bought it in 2020 and sell it in 2021. Like big difference. You know what I'm saying? Like
Yeah.
such a big difference. And so I think that the context always matters a lot. And I really try to do my best to provide that context around any of my commentary so that people understand that um, investments are inherently complex and some of them lose money.
Yeah. 100%. And I think that's what ruffles people's feathers a little bit is they're like, hey, don't, what are you doing? uh,
Yeah,
but it's the truth. And I think LPs need to be educated. And I think you've said this before. It's like the things were so good for so long where I feel like so many in this industry has had a lot of exposure over the last decade, right? Not
yeah,
only with the Jobs Act 2013 that opened the doors to a lot more a lot more openness where people that weren't exposed to these investments are all of a sudden exposed to these investments, but social media and so on and podcasts. And so there's been a lot of exposure and I feel like because of that exposure happened during a boom time and everybody
yeah.
thought that they couldn't lose money on these deals. Everybody thought like these were the most safe, secure investments possible and you can't lose money. And now they are backed by real estate. They are I mean, relatively safe. And of course, that there's varying degrees of that too within the industry.
That's right.
Um, but there's also a lot of things that you need to look out for and be aware of. And if you're not aware that you can lose all your money or a portion of it, you probably shouldn't be investing.
Right. Maybe I'll just add a little bit of rephrase is like what I always tell people is that if you can't find three ways in which you can lose all your money using numbers, you probably shouldn't invest.
Mhm.
In other words, or like meaning you shouldn't invest at all. Like you should just like do some more education before you invest. In other words, that just tells me that you probably don't understand the investment enough to figure out, oh, like if this variable changes, that will have a massive effect on my returns and I might lose money, right? Oh,
Yep.
and this variable, and of course, most people are like, the response to that, oh yeah, like I know the three catalysts. Like if COVID happens again, like I might lose everything. Or they might say, if a fire happens, I might lose everything. And I'm like, that's not what I'm talking about. Like those things are just totally unpredictable, and that's just the risk of having capital at risk. Um, but I'm talking about sort of things that you can model, reasonably predict, or at least sensitize, right? I really think those likely catalysts are super important.
Yeah. Yeah, I agree. And one of the things we put in a lot of other GPs put in their slide decks are sensitivity analysis to try to
Yep.
show LPs. where this investment or how could this investment go wrong? Like what happens
Yep.
in certain scenarios if things don't go well? And then we can continue to tweak those models and see even varying degrees, even more to each extreme as well. But I think that's valuable to understand. And you can never model and predict every way a deal can go wrong. I mean,
Of
there's just
course.
too many
Which is why I think
variables.
you need to have some room for error,
Yeah.
right? Um, that's where sensitivity tables are super important.
Why did you decide to go this route and start this this business that you're doing right now?
Yeah, a few reasons. I mean, I wanted to build something on my own. Um, I had decent amount of experience in the institutional world, had some experience in the syndication world that kind of made me realize how big the gap is between, I guess, let's call it GP knowledge and LP knowledge, right? And also the lack of transparency many times. And then I just realized how massive the market is. In other words, how many dollars are being invested per year in the US alone. On average, I think the dollars that are invested are not coming from like a super sophisticated investor. Um, and I did a little bit of research, not like a crazy amount, maybe an hour or two. And I found some like smaller competitors. Well, I shouldn't say smaller. They're probably bigger than I am, but they weren't like massive. You know what I mean? Relative to how big this market is.
Yep.
And so I decided to go after it. It was really just that simple. You can actually, I don't know if you're on Twitter, but you can actually see the entire founding story unfold on Twitter. Because at some point I was, I got like a message from a friend, and he was like, "Hey, I'm thinking about investing a few hundred grand into this thing. Like, what do you think?" Um, and I sent him some what I would consider simple feedback, and his response was, "Hey, can you remind me what a cap rate is again?" And I was like, "Wow, like and at first, to be honest, I was like, oh, that's just him. Like, that's not normal." And then I realized it's pretty normal, you know, which is exactly what sort of made me go after this market, and try to educate people.
Hmm. See, and that's what I was talking about at first. Like I, it's hard for me to go back to that. Like I don't know what a cap rate is. Like it's just
Yeah,
to me, I've been in the industry for long enough where it's just a piece of language that I use all the time,
yeah,
and it's hard for me to think back to when I didn't remember that. Right.
yeah.
So you talking to these LPs all the time definitely helps. Um, what what do you see? Are there like three, five like big mistakes or a certain amount of mistakes that you see LPs make over and over? Like what are you seeing that's a trend where people trip up
Sure.
or some a few big things you're saying, hey, like you got to really understand this.
Yeah. So there's only one red flag that I've ever published, and that was seeing any mention of the word guaranteed in anything, even if it's personally guaranteed. So
Yeah.
I mean, we can have a longer discussion on that. I have a whole article on it if people want to read it. Um, the story short is that even if something is personally guaranteed, those payments are still not guaranteed, in my opinion.
Yeah.
They're personally guaranteed, but not guaranteed. Different, different things.
Yeah.
Um, so that's really the only red flag. The reason why that is, Todd, is I try to be very careful with using the word red flag. Typically, the way that I think about a red flag is like, you wave the red flag and you're like, oh, this is like insane. I'm out, right? Based on that one factor. And the reality is in investments, such sort of like binary one flag and I'm out is very rare, right? Because investments inherently like um the different factors live next to each other, so to speak, right? And you have to dissect the whole thing. So I'll just give you an example. Like you see a deck and you're like, you see a 50-50 split and you're like, whoa, like that's way more aggressive than normal. Like I'm an LP and like I'm putting all the money in or most of it. And I'm expecting to see 70 to 80%. Like that's normal. So how could these people like be so outrageous and ask for 50-50, right? And then they just put the deck down and go to the next one. But they forgot to go to the next page where it said that there's a 50% co-invest, which is way higher than a regular one. And oh, by the way, there's a 9% pref or a 10% pref. And oh, by the way, they've been in business for 30 years and like here's their track record or whatever. I'm just making this up. But my point is, if I would have said like, oh, 50-50 is a red flag, people would be like, oh, I'm gonna pass. And I just don't think that's how this works. Right. Like you have to see
Good
the other
point.
factors.
Yeah.
And another one is like, so I see this stuff on LinkedIn all the time, and like I really don't like it. It's like, um, if someone has less than 5 years of experience, red flag, and I'm like, that's terrible. Like that's not true. Like everyone had to start at some point. Everyone had to do a few deals in the beginning. Now, I think it is fair to say that those beginning deals are, if you isolate all the other variables, so to speak, just from an execution perspective, they carry more risk
Yep.
than the deals that they're going to be done in year 10. From an execution perspective, of course. And like, yes, as an LP, you should expect to be compensated for that, right? So you should sort of compare that against your other offerings and see whether their terms make sense based on the fact that they're pretty new. But you don't just put the thing down and say like I'm done, right? That's not the point. So I have a whole article called Top 15 Syndication Mistakes. There's a bunch of stuff in there. But what I call them isn't red flags, it's like reasons to stop and think. In other words, I do think it's fair that if you see a 50-50 split, you're like, oh, that's not usually market. Let me see if something else compensates for it. If you see track record that's really short, it's like, oh, okay, like no problem. Like short track record, I got it. I put it down in my notes. Like, let me see what they're offering and if the deal is good and if I feel like I'm compensated well enough compared to my other deals to take on that additional execution risk. If not, put it down. But don't don't just give up because one of these things is off.
Yeah, I love that. You got to look at the whole picture. There's so many things that you could just point to, and I agree. You could point to so many things that are, the quote unquote red flag, but is it really? It's something to pause. It's something to think about.
E-
It's something to
Exactly.
realize what kind of risk, that might add to the deal, but doesn't mean that it's a bad deal. And the other thing with a good deal too, I see so many people. I talk to LPs and they're like, "Hey, I'm looking at another deal, and their IRR return is better than yours, and so I'm going to go with theirs." And I'm like, "Okay, that's fair. You have every right to do that, but did you really dive into why their IRR return is higher than mine, and what that really means, right?
Yep.
For the risk profile, did you look at the financing type? Did you look at how many years they're holding or projecting to hold? There's so many
Yep.
factors in play for some LPs, I think, were so tied to these. Oh, it's got the highest IRR. That's the deal I want. That's all I'm looking for.
Yep.
The best
Yeah.
splits. Go back to the splits. Like, oh, that yours is 70-30.
Oh, Todd,
80-20.
I hear this all the time. I mean, we can talk about this one thing for an hour, but I'll just mention like two things. One is I hear the IRR thing all the time. I like very publicly say that focusing on IRR as sort of a filter, right? Which happens all the time. I mean, I would tell you it's probably like 70% of LPs do this.
Well,
This isn't like a statistical number, it's just kind of based on my conversations.
yeah.
Um, but they look at a deck and they're like, oh, 15%? Like next, right? And then they see 20%, like, oh yeah, I can get behind the 20%. Like, yeah. Like money market right now is like 5%. 20% sounds solid. Where do I send the wire? And so I've again I've written about this at nauseum, and it's like you you are in my opinion, you're like filtering out the the deal that is actually good on a risk adjusted basis because the GP is being conservative and they want to like exceed expectations. And there's a decent chance that you're filtering in a deal that is like super risky and super aggressive. Um, of course, this is not always the case. Like there's definitely deals exist that are 20% conservatively, right? But across a large enough sample size, that's just not true, right?
Right.
So, and again, if you're a large allocator allocating 100 million checks, and like you have your own hurdle to hit, and you get 20 of these decks a day, then of course I understand. Like you got to filter this stuff somehow. Can't look at all of it. So yeah, so maybe you begin with IRR, no problem. But the problem is with allocators, once they filter through the IRRs, there's still 100 deals to look at, right? And out of those 120% IRR deals, they're going to find the best one, right? So that's why such a filter makes sense. With like in a retail LP, they, they have like one deal and they're like, oh well, this is a great IRR, so I'm going to invest, right? And so I mean that's the one thing I would say. Um, the second thing I'd say just briefly is um, there's I've experienced this a lot, and I've actually stopped taking these calls. Um, there's people that reach out to me all the time, and they're like, "Hey, I just need 15 minutes of your time. Like, I don't want you to like give me entire feedback on the deck. I just want to get feedback on a few terms." You get on those calls, and inevitably, it's like, yeah, like I mean, I think I know what I'm doing. I don't really need help. Um, hey, by the way, is 70/30 split normal? Like, is that normal? And I'm like, I mean, outside of any other context, yeah, I think that's normal. It's within range, yeah. And they're like, oh, okay, cool, cool, okay. And 7% pref is normal, and I'm like, yeah, that's within range. It's normal. Like, all right. And 2% acquisition fee, and I'm like, well, like, yeah, on a smaller deal, totally normal. And they're like, all right, cool. Like, I'm so thankful for your help. Thanks for the time. Um, and then a few months later, they reach out to me and they're like, hey, like that conversation we had, I'm really thankful for your time. I ended up investing. And I realized that like those conversations, like from my perspective, are like very risky because people ask only the things that they know to ask about, right?
That's a good point.
And that I mean, that sort of presents its own can of worms, right? Because it's like you ask me like the most basic questions ever, and yes, those things are within market, but I did not tell you that this is a great deal otherwise, right? You told me you sort of did your own analysis, but I have no way of seeing it or understanding it, right? So, yeah, I mean, I think that's a real challenge. And by the way, just to connect it back to the IRR thing, like that happens with IRRs all the time. Like, yeah, I'm going to invest in this. I think I know what I'm doing. Like, I saw a 20% IRR. And Todd, you might say, well, yeah, but did you check the debt? But did you check this? But did you check this? And they're gonna be like, oh yeah, yeah, like I checked it. Like it's better. I like this deal more. And the only thing you can really say is like, okay, cool. Like, good luck. Like,
Yep.
and by the way, they might totally crush it, right? That's
Yep.
that's the other thing that's so difficult with investments is, um, you know, when people hire me for help, I never tell them to invest or not. Like my goal is to sort of make sure they understand the investment better, right? And then they make their own decision. Um, the not majority, but I would say a decent minority, I would say especially the wealthier clients, will inevitably make a comment like, well, okay, this was really helpful. Now I see the risks a lot more and the reward, and like, I have a much better understanding of the deal. But like, should I invest? And they just look at me, right? Um, and and I just remind them, like, I can't tell you that. Like, I'm actually not registered
Yeah.
as an IRA, like, so I can't legally tell you that. A and B, I think as an investor, you need to be able to like think through this on your own.
Yeah.
right? Like that's the whole point, right? Is to become more independent. Um, and part of that is realizing that like, yeah, there's like these risks that I found now and I understand, and that maybe the GP did a good job of addressing and mitigating to any extent possible. And there's this reward that I'm looking forward to. And like, is this a risk reward that I'm comfortable with? If yes, you invest. If not, then you pass, right? Like, but that's the investor journey.
Yeah. Uh, We're the commercial real estate industry is going through a bit of a change, right? We went through the last 20, maybe not 20 years, I guess, 15 years of just great news, and things were going upward. And now we're seeing, capital calls. We're seeing deals, not a lot of foreclosures, but we are seeing a few. We're seeing prices have gone down. Multifamily, 15 to 25%. Office obviously totally different, even more, with more distress. But anyways, we're seeing a lot of differences happening in the market. What do you I guess, what are you seeing in the market for opportunity, for potential for LPs, for GPs? What are you kind of excited about and interested in seeing how it unfolds?
Yeah, I mean, I think to some degree, um, I think to some degree it's very exciting to be an LP right now, right? Because I'm not convinced that the reset is done, right?
Yeah,
In terms of pricing,
me too.
but it has certainly, we're a long ways apart from where we were in 2021, let's say, in
Yeah.
terms of pricing. Um, and so that's pretty exciting, right? I mean, you're starting to get deals that, in terms of pricing, have not made sense in a long time. Um, I think there's some reasonable, um, I guess you can say like investment anxiety, like around maybe some past investments that didn't go work out, right? But overall, it's actually a pretty interesting time to invest. I think some of the deals that I'm seeing are starting to make more sense, right? They're starting to be pretty good. They're pretty rare though, like meaning and that's not a percentage statement. I mean, I just mean the likelihood that a GP ties up a deal now is lower than in 2021. Like
Right.
people are just generally less aggressive, so there's less deals to raise money for. But I think there's like a ton of money looking for a place to put the money.
Well, but
I think
it's nervous money, uh, right? I mean, there's a lot of money sitting
like
out there, I feel like, but
kind of, but I
yeah.
mean, I get calls. It's not weekly, but in some cases it's bi-weekly that are like, hey, I just sold a business and I have, I don't know,
Mm,
20 million liquid. One time I was like 100 million liquid, and they're like, I want to invest it in this deal, and I heard about you. And I'm like, okay, hi, like, what do you mean it in this deal? And they're like, well, what do you mean? Like, I'm gonna put like the 20 million in this deal. And I'm like, okay, like, how much time do you have? Like, like you'd be surprised. In other words, like, there's like a ton of capital out there. Of course, I want to sympathize with GPs. Like, it sometimes it's difficult to find it,
yeah.
right? But but it's there, it's
Mm,
there, and like you would be surprised like how desperate people are to put it out, because I think everyone knows right now that there's inflation going on. People generally like don't like to sit on just cash and
yeah.
treasuries, right?
Yeah.
Especially people that have net worth of that size. Um, they just want to see the opportunities, right? They want to see them and they want to understand them. And yeah, as I said, it's harder to come by deals nowadays in general. Not even good or bad ones. I'm just saying in general. Like it's just much harder to transact.
Yeah, it's we've had a big struggle as a GP finding deals. There's just not as many deals being sold, first of all. And of those deals, I mean, think about it. Like, look, if you're the owner of a property, do you really want to take a 25% discount? No, you don't want to. So you're either not going to sell or you're just going to hold on until somebody either pays that or, so a lot of the deals we see
Yeah.
never end up transacting, or they do because it's a 1031 exchange or something like that and somebody's willing to pay the price. But the vast majority of deals that we see just they don't even pencil out. And so, yeah,
Yep.
there's way less deals out there happening right now. And rightly so. I mean, we're not selling our properties to take a 25% discount. Why would we?
Yeah.
Um,
Yeah. It makes sense. That's why the bid ask spread just doesn't make any sense.
yeah. What about a GP? Um, what's your advice to a GP that's either going through a capital call, has done a capital call, knows they're going to be doing that, or losing, investors' money? Do you have any advice for them?
Yes. Um, Sorry, I'm just trying to find the article. So if anyone is interested in like a long form answer to this, I have a whole response to this on it's called My Deal is Distressed, Now What? Um, and that is something that is written both to LPs and GPs. Um, in short, I think the answer is communicate early. That's I think by far the biggest problem
Mm-hmm.
is, people wait until last minute and they surprise people. And honestly, sometimes that ends up in litigation,
Yeah.
right? Because like at the end of the day, you're partners, and like if something material happens, you should know about it and plan for it. And the beautiful thing about real estate, Todd, is like on the one hand, you can't predict markets, right? And by the way, while we're on the topic, was very difficult to predict what the Fed was going to do. I totally hear that. I couldn't have predicted it. The top economist, I shared like a it's pretty funny if you get a chance to see it. Like if you look at the predictions of the top economists over time, relative to where the rates actually are, like it was just like all over the map, like
Yeah.
completely off, like most of the time. And so it just reminds you like these are very difficult things to predict, and the only thing you can do is sensitize and mitigate, right? So um I think here it's really important to communicate early. The beautiful thing about real estate, that's what I was just saying, is you know when your rate cap is due. You know that date. You know when your debt is due. You know that there's a chance of having a cash in refi. You just don't know the exact dollar amount, but if it's somewhere between 1 million and 5 million is greater than zero, and you should probably say something earlier rather than wait until you know what the number is, right? Just so that people have the expectation, right? And so that's the first thing is just communicate early. Um, I also have seen, I know this is very difficult, but like I've, I think there's like three types of capital call emails or communications that I've seen. One blames the Fed, or like shifts the blame to like we did our best, we're great, but the Fed screwed us. Um, I don't think those types of communications go over well.
No.
There's the middle ground, which is like, like we tried our best. We don't really take responsibility for what happened. It was hard to predict, but we tried our best. That's sort of like the middle ground. Um, I think if you're uncomfortable with the best, which I'll describe in a second, like at least go there. Don't go to the extreme and say like, it's all for the Fed's fault and like blah blah blah. I think the best is like, look, like to some degree, we take responsibility. Like we're learning. Here's a few things that we learned. Here's what we've done. In many cases, like here's the money that we put in and the times, right? And here's what we're doing day to day. like at the end of the day, you have to remember that you're talking to people and you're a person and people relate in a way that I think most GPs like forget about this. Like they, you're just talking to a person. It's not like a number. It's a person, and they have their own like emotions. In many cases, by the way, they have their own sort of like retirement planning, and this investment going bad might have a massive effect on that, right?
Mm,
In some
good
cases,
point.
like a scary effect. I mean, I
Yeah.
can tell you all these stories, but um, just again, communicate early, be transparent. If you want like a full list, I like really went after it on that article. But um, I mean, and maybe the third thing is just like tell people how you came up with your decision too. Like I usually think that's missing. Like many times the GP is like, hey, we have a capital call. We need it for X, such as a rate cap or cash and refi or whatever. Um, and we think this is the best course of action. You have a week to send the wire. And it's like, well, why is that the best course of action?
Yeah.
Right?
Yeah. What's your
Well,
business plan
why?
behind it?
Yeah. And by the way, I mean, you would hope that they did that analysis.
Yeah.
I think nine times out of 10, I wouldn't say 10 times out of 10, unfortunately, but probably nine, they did do that analysis and it's probably well thought out to some degree. So why not share it? Like,
Yeah.
like we had this option and that option, and like we were thinking about this and that, and like we could even bring outside money instead of doing a capital call, but that's going to cost us X, right? And we're deciding to do this because as you can see in these options, like this makes the most sense. I think that type of argument carries a lot of weight because it's transparent. You're showing your cards, which you should, like you guys are partners. Um, yeah, hopefully that helps.
What do you think about as an LP? Like an LP deciding, should I do that capital call or not? Are there a few things that they should be thinking about?
Um, Meaning if they get a capital call, what should they do?
Yeah. Should they put the money in or should they not? Right. Cause I hear that a lot. I see it on bigger pockets. I see people, I hear people talking about it all the time. Like, I'm not going
Yep.
to do that. Or why would I do that? Like, well,
Right.
maybe it's a bad thing. Maybe it's a good thing, but what are you looking for?
Um, so I have like a whole methodology that I've developed with a bunch of steps. I think in terms of tips, I would say, and by the way, it's in the same article, same thing. My investment is distressed now. What is what it's called? Um, um, the biggest thing I would say is you need to understand what happens if you don't invest, right? That's surprisingly missing in a lot of GP communication, and LPs don't understand it, right? There's a big difference between getting diluted pro rata, right? Which I would say is sort of like the most favorable option. And the least favorable option is, kind of, in traditional finance investing terms, you kind of call it a cram down in a sense, meaning any existing investors um either get put behind some sort of pref, right, in terms of seniority, or they just get diluted like 5x, let's say, or 10x, right, like a very extreme number. So um it although it is true that the money that you invested is a sunk cost, um in relation to like the new dollars that you're investing, um it kind of is a sunk cost but kind of isn't, because all of a sudden, like, if you don't invest, let's say, another 5%, and it's so small, all of a sudden you get a 10x dilution, right? And how does that impact your overall returns once you get to the end, right? And so that's a whole other article that I wrote about with a whole model. But I think I would just encourage people to understand first, like, what happens if you don't invest. It's pretty basic, right? Um, the other thing is, again, something I see that's missing a lot is, how do I know that this is the end? In other words, I see capital calls all the time that are like, oh, like, um, we need some money for a rate cap. It's going to be great. Here's the dollar amount. And then you start looking into the deal, and there's like a debt maturity in 9 months. And you're
Mm.
like, okay, like, so what are we gonna do with the debt maturity?
Yep.
And the answer is like, oh, we were planning to do another capital call.
Yeah.
Which again, I don't mean to laugh. Like that's the nature of where you are, and there's no problem with that. Like if you're there, you're there, but you need to communicate it and show that you're capable
Yeah.
of understanding like sort of the larger picture as opposed to like being in the moment and like, oh my gosh, we have a rate cap, we need to buy a new one. What about what's going to happen in a few months? Like, is that going to be enough?
Yep. Yep. There's a lot to think about as an LP investor and a GP, quite frankly. It's not all bad. We've probably talked a little bit more negatively, but it's there's definitely it's not all bad. There's a lot of people that make really good money doing this and in this business, and it can be a great investment. But I think where you come in is trying to think a little bit more critically about the investment that you're making. Like you said, it's you take a little bit more time and analyzing these deals, and you're going to get into the right ones, the ones that'll make you money. Um, any last pieces of wisdom advice you want to leave us with? Otherwise, I got a couple last questions I want to ask.
Um, I'll just say one thing, and it's controversial for some reason. Um, if you don't have money to understand what, if you don't, I'm sorry, if you don't have time to understand what you're investing in, you shouldn't invest.
Yeah.
Um, um, I think there's this notion that LP investments are like this like passive vehicle, and like you just put your money in and it grows, kind of like maybe you can connect it to like a stock market index, right? And in fact, many times I see GPs like make these comparisons, and they're comparable in the sense that they're both investments. Um, but they're not comparable in a ton of different ways as well. Um, and so I think again, if you don't have there's always exceptions. Like if you're an investment professional, right? Like and you understand this stuff, so then obviously it's going to be easier for you. Um, but generally speaking, if you don't have the time to understand what you're investing in, not like super deeply, but at least somewhat deeply, um, I think that's a sign that you should just stay out until you have the time.
Yeah.
Um, yeah, so a lot of people have an issue with me saying that, but I genuinely believe it.
Well, when I have a new investor call, I'm sending them a big package of Q&A, that just questions that investors have asked, articles that I've written, um, previous deals that they can look through, OMs, the underwriting, things like that. And then I encourage them to just take the next 6 months and study and learn and read books about this. And like you can literally look at all the deals that are being offered through crowdfunding sites, and just start to get to know the industry, because you do want to know what the what a cap rate is. You do want to know about, I think most people get so confused when they look at some of these deals, and they don't even think about the financing and the risk that the financing adds on. You're investing in a deal that's got bridge debt. Do you even understand what that could do, what that means for your investment? Not that you shouldn't invest in that deal, but you should
Yeah,
understand that's a different risk profile than somebody who's got, an agency debt loan that's locked in for the next 10 years, right? It's just a
right,
different risk profile. And most people, I think a lot of LPs don't understand truly what they're investing in and
right,
the little nuances behind it.
right. Yeah, I agree. And I think the bridge debt comment just falls into the same sort of reasons to stop and think.
Yeah.
commentary from earlier, right? It's no different than seeing uh in what you would call like an outside of market split or an outside of market fee, or right, like if you see any of those, they should, you should sort of just be aware, take note of it, and continue. Same with bridge debt. There is a reason why a bridge debt exists. I think it can be pretty amazing in many ways, but you need to understand its implications, right? And so, um, yeah, I think context is like really big in all of these things.
Yep. Aleksey, what's a book you can recommend to our listeners?
Um, I mean, maybe I'm going off the rails, but I'm gonna do a podcast. um, I actually really enjoy Founders by David Senra. Um, he actually reads a bunch of biographies, mostly books on like people, and I find it to be very fascinating. I sort of, that's my reading time, if you will, summarized through him.
Hmm, interesting. It's called Founders.
Yeah, David Senra. You should be able to find it. Yeah.
Got it. All right. Last question before we wrap up. What are your three pillars of wealth creation?
Um, I think the pillars would be the order sort of in which I would invest my money, which again, some would consider controversial, but I think as you're sort of building wealth, I think you should first invest in yourself, meaning yourself, your career, your training. Then you should probably invest in the index fund of some sort. And only then you should start thinking about like private placements.
Yeah. Yeah. I couldn't agree more, actually. I think that's a great, step direction. Like you gotta know what you're doing no matter what. So you got to invest in yourself. You got to invest in your education. You got to invest in the regular market. Like it's easier, just easier to get going, easier to understand. There's a ton of information out there. There's a lot of advisors out there. And then start playing in that private equity space,
Yep.
where, you there's a lot more hidden. I would say there's a lot more. It's a lot more to navigate, and you definitely should be more sophisticated.
Yep.
So, how can our listeners get in touch with you? Learn more about what you got going on.
I mean, my name is pretty unique, so you can find me on Twitter, X, or LinkedIn. And as you said, I write twice a week, and that's at lplessons.co, co, lplessons.co.
Awesome. Man, I appreciate the time. And again, I really appreciate what you're doing. I think you're doing a huge service for the industry, whether some people don't like it or not. I don't care. I think you're doing an excellent
Thank
service
you.
to the industry. And I think it's going to pay dividends in the end. And I've got a mindset where if my investors are well educated, um, they're better off. And so I want my investors to understand the risks and rewards and be
Yeah,
very educated, and I think that serves everybody in the end.
I agree. I just really quickly, I'll just note that I think it's very nice when a GP tries to educate their LPs. Um, but I don't want to get it twisted because I don't think that's their responsibility,
Mm,
right? Meaning, um, the LP needs to understand, and by the way, this goes both ways. Like the responsibility of getting training, right, and getting an understanding of what you're investing in falls on the LP. Um,
yeah,
and that I think there's like this notion that like, hey, if my GP is helping me understand, therefore I should invest because like look at how much they know. And that might be true, right? But that could also not be true. Like there's a lot of like really bad cases that I've seen in that
yeah,
world. Um and I just again I think it's a very nice concept, and you should, and everyone should continue doing it to sort of like um make people understand what they're investing in and spending time with them. I think it's sort of a natural part of the investment process. Um, I just don't want LPs to think that this is a GP's responsibility. I don't think it is.
Yeah, no, good point. Good point. It's ultimately your responsibility. Look, you're responsible for your own decisions. We're all adults here. And I had that conversation with my son today. He spilled some strawberries on him that were sitting on the fridge in a little bit precarious position, and he knocked them down and it got all over him. And he's like, "Well, whoever put those strawberries there, that's their fault." And I'm like, "Look, you got to take responsibility for yourself. You moved the whipped cream in the fridge and it spilled the strawberries. That was your fault." So I agree. LPs, they need to take responsibility for themselves. GPs, you need to take responsibility for yourselves, and we're all better off if we take responsibility for our own selves and our own education, and we'll be better off. So,
Yeah. Awesome.
Aleksey,
Thank you so much for
again,
having me on.
man, really appreciate you, and you have a fantastic rest of the day.
Yeah, you too, man.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.